So before I start today's session, let us have a look on that 1SD trend levels, what we have calculated for the week and what has come in the market, or what has happened in the market and what we have calculated. So our 1.236 target for Nifty for this week was 8966 and we have gone till 8957. So we have achieved till 8957 and in fact closed at 8926 level, so at 0.888. So tomorrow is only 1 day is remaining, so we have achieved till 8957. Day's high was 8957. And if I can look into this bank nifty, so we have calculated 20,914 and we have gone till 20,927. So 13 to 14 point more we have achieved above this last but one target. So this week is a good week for the weekly traders without much difficulties, without giving any stop loss triggering action. Steadily the price has reached to our expected level, and with hedging each lot of Nifty and Bank Nifty has produced more than 3000 profit per lot. So this week was one of the successful week. So this is what happened for the Nifty and Bank Nifty for this week using the one standard deviation. And the recording of the earlier two sessions are available in this YouTube channel. You can visit our YouTube channel and see the recording of the last two events, what we have done on 20th and the 21st of Feb. So you can access those recordings from this link. And today's agenda of discussion is the beta decoupling pair trade technique. Also, I'll discuss how you can utilize the beta decoupling technique to choose a best stock for your short-term investment. You can utilize that principle for short-term investment objective. I'll also take you across to the technical concept, how you can analyze a chart pattern scientifically. Yes, many chart pattern analysts, they used to just look into the chart and say that it is looking like this, that's why we are saying it's a double top, double bottom like that. However, that shape or that graph of the price time, if it look like or if it give a proper shape, you should not conclude that it has formed that particular pattern. Rather, you need to see that how much time it has taken, how many candles are there, and if that pattern is a successful pattern where it will give you the breakout and where what are the price points or what are the actions will say that that pattern is a failure. So I may not be in a position to take all patterns, but one pattern at least I will show you, so that how we used to analyze on the pattern and how you should learn pattern, so that also I'll take in today's session. Beta decoupling pair trade technique. So this is one of our oldest innovation. In the year of 2006, Smart Finance has brought this concept to the public domain, and so far this method is giving great success to the traders. You can utilize this particular beta decoupling technique, pair trade technique in intraday as well as in the positional trades. However, it is much more effective in the positional trade, and this technique having a great analysis behind it. So the concept what we are using here, the beta. So here the beta, whenever we talk about a high beta stock, low beta stock, and sometimes the market portfolio beta, all these terms we used to use with prefix or postfix of the beta. So the actual literal meaning of beta is, it is the sensitivity, it is the relationship. So between when you compare X and Y to stocks, how they are related in their price terms. Means if X changes by 1%, how much percentage the Y will change, that is known as your beta. So we used to take a past price action, calculate this factor of beta, which is a statistical calculation, and that beta gives you the relationship between X and Y. If beta of X and Y is 1.5%, that says if X changes by 1%, then Y will change by 1.5%. If the X and Y beta is negative 1.5%, this says that if X gives positive change of 1%, the Y will give negative change of 1.5%. So this is what the beta meaning is. So what is a decoupling factor in that? After calculating this beta, certain times whatever the beta says, the stock never obey that, or the price action of that particular stock never obligate that beta relationship, and that results in the decoupling. And that decoupling gives a fantastic opportunity for trading. And if you are a trader, you can very well exploit this situation for your profit. And why this decoupling happens? Normally, the decoupling of the stocks or the beta decoupling happens due to the large portfolio churning. Many mutual funds, FIs are involved in the market. For some or other reason, when they start churning their portfolio, when they go for realigning their portfolio, some amount of decoupling happens. So once you do this mathematical study, you get the information about the churning or the realignment of those majority of the large investors, and you used to exploit that things for your profit. So I'll just go in detail about that. So this is a very simple process, and this process starts with, you have to calculate the 10 days data, past 10 days data you have to take and calculate the beta. Why this past 10 days data? Like the 10 days moving average, 10 period moving average. So the past 10 days price action already standardized by the trader. Most of the trader follows this 10 days moving average, 10 period moving average concept. Henceforth, I am taking this 10 days data. Though this method I have simulated in different group of data, however, the 10 days data given the most successful outcome. You have to calculate the beta. You have to identify any decoupling nature if it is existing in that. Since we are taking X and Y two stocks, or one index and one stock, so one we have to name as dependent, another we have to name as independent. So X will be stock, whichever we are putting in the place of X should be independent. Stock which we are putting in the place of Y should be dependent. And this independent and dependent nature of the stocks will be defining through their volatility. So any stock having higher volatility. So if X and Y are two stocks or stock future, we first have to compare the volatility of both the X and Y. So anyone having the higher volatility must be considered as independent, and the stock having the lower volatility as compared to the other will be dependent. The reason the higher volatility stock will react more towards the demand supply situation, henceforth it must be taken as independent. When we are taking X as an index and Y as a stock, that time index, irrespective of its volatility, has to be taken as an independent. So when I take Nifty, Bank Nifty along with any stock, that time though their volatility will be lesser than as compared to the stock, but they will be always considered as independent. After placing these two things, after calculating this beta, after calculating this decoupling, we have to find out the net decoupling. Addition of all decouplings will be taking from the beginning period to the last period when we are going to do the trade. And ideal condition to buy the dependent is negative -1 to negative -2 dependent. And same way, ideal condition to buy the independent is +1 to +2. In between -1 and +1, if it is there, then we have to hedge it 100%. So this is also another rule associated with this particular concept. So let us see how it works. So I have taken the Bank Nifty and SBI. So Bank Nifty is a index, henceforth it must be independent. SBI is dependent. Then I have just taken their pricings. So I am just taking the past 90 days data or the past 3 months data to demonstrate this particular method. So 3 months, what kind of action it has given. So I have taken their price actions. This is the future, Bank Nifty future and State Bank of India future. So every day basis, how much percentage of gain or loss it has given in the pricing terms that I have calculated. Then I have calculated beta. So for calculating the beta, there is a very simple formula, covariance of X and Y. So here X is this thing. So all chain of values you can put it in Excel, covariance of X, C3 to C11, comma, the covariance of Y is from E3 to E11. So covariance of X comma Y divided by variance of X. So this is giving you, this is the formula for beta. Since I am taking the 10 days data, so it will be n divided by n minus 1. So the formula what is required for the beta is covariance of, so this is also a statistical formula. It is already available in the Excel. So X and Y divided by the variance of X. So this is the first part of the formula, and this need to be multiplied with n divided by n minus 1. So this is n is number of period. So how many days data you have taken. So by this process we have calculated the beta. So once we have calculated the beta, what does it says? For the 12th January, it says beta is 1.13%, means Bank Nifty, if it is changing by 1%, it says if the Bank Nifty changes by 1%, State Bank of India should change by 1.13%. That is the meaning of the beta. So on that particular day, Bank Nifty has just moved by 0.35% and State Bank of India has moved negative 0.2%. So as per this 0.35, so Bank Nifty should move by 0.4%, that is nothing but the beta multiplied with the percentage changes given by the Bank Nifty. So that is the expectation as per the beta, and decoupling has happened how much? So whatever the actual thing happened minus the expected thing. So this is your decoupling. We have expected positive 0.4 change would come. However, it has given negative 0.2. Henceforth, the decoupling, the deviation, the non-correlation, or the disobey factor from this beta, which is named as decoupling, was negative 0.6. Same way, for the next day we have calculated. When next day we have calculated. This we are going on calculating, and once it is going above 2, plus or minus 2, that time we will be initiating the trade. For the better result, we will always initiate the trade once it moves to plus or minus 2. So I'm just going on adding these decouplings day on day basis. So here is the chance has come where the net decoupling has come to 1.97. So here on 31st January, this is for March expiry I am taking. At 31st January, it has given the minus 1.97. So negative means I have to buy the dependent and sell the independent. So here independent is Bank Nifty and dependent is SBI. So if it is in the future segment, so SBI is having a lot size of 3,000. So here I'm just taking that price into account, 3,000. So I'm just buying one lot of SBI and selling one lot of Bank Nifty. Contract terms almost they're equal. One contract is here 7,84,000, other contract is 7,86,000. And this beta decoupling what has come here at minus 1.97 where this trade is being initiated, then it has started bridging and sometime it has started expanding also. So this factor of bridging has taken 3 days, though it has taken 8 to 9 days to accumulate that beta. But by 3rd Feb, this entire decoupling, which was there minus 1.97, has come to minus 0.34. So this decoupling has recoupled and this recoupling has come to minus 34. So that time let us see how much profit we have got. So here 278.95 and 20,337, this is the pricing on that particular day. So if I just take the factor, I bought the State Bank of India at 261. It is at 278.95. With the lot size of 3,000, I am making 52,500 profit here. At same time, the Bank Nifty which I have sold at 19,658, it is at 20,338 and I am making a loss of 27,000 here. And this recoupling action, addition of both the things is giving me a profit of 25,332. So decoupling happened, I initiated the trade, recoupling happened, I booked the profit. So decoupling happened, I initiated the trade and recoupling happened, I have booked the profit. So this is what the principle is. So by this process, here recoupling happened, negative, slight negative is there. So then after it has again going on expanding, very next day it has expanded to negative 0.81, again some positive factor come to a zero level. So you could have entered a second trade here. So come to zero, then it has again come expanded. If I will just see all these results, now on 21st February, which was yesterday, if I take the sum of all these things, I'm just sitting at a minus 4.05 decoupling. Net decoupling from the past 3 months data investigation says I am at a negative decoupling of minus 4.05. So what action I should take? So earlier investigation I saw that yes, whenever the decoupling is there, I should initiate, and when that decoupling happens, it transforms to the profit. So currently I am getting a decoupling of negative 4.05. Can anyone will suggest me what when that accumulated decoupling goes to above -2, that time you should buy the dependent and sell the independent, and when the accumulated decoupling goes to +2, that time you should buy the independent and sell the dependent. So how to choose a independent and dependent, that also I have told you. While choosing the dependent and independent between two stocks, you have to take the stock which is having the higher volatility as independent. While comparing between a index and a stock, you must take the index as a independent and stock as dependent. So like this way, if you just look into the other pair like Bank Nifty and HDFC Bank, this is having plus 3.92. So what action need to be taken? So similar result you can get if you just calculate and go through this, you can get the similar result. So I have just taken the Bank Nifty and HDFC Bank. So here it is coming plus 3.92. So what is the trade action one should take? You must take 3 months data, trailing 3 months data to calculate the net decoupling factor. So here I have taken the Bank Nifty and HDFC Bank. So the net result comes here 3.92 plus. So which one should be bought, which one should be sold? While comparing between the stock and the index, index will always be independent. So in this case, the independent, which is Bank Nifty, must be bought, and the dependent, which is HDFC Bank, must be sold. You need to see in one lot of value how much it is coming. One lot of contract for Bank Nifty, if it is 8 lakhs, one lot of HDFC Bank is how many lakhs, that you have to look into, and you have to do a adjustment accordingly. So either 2 lots and 1 lot, 3 lots or 2 lots, something you have to do so that your buying side and selling side must match. So I have come to another one pair here, Bank Nifty and ICICI Bank. This is you are getting negative 5.54. Negative 5.54. So in this case, definitely we will be buying the ICICI Bank and selling the Bank Nifty, and we need to see the contract value. So this opportunity of beta decoupling always exists. So always exists. Only thing is that we need to initiate whenever that opportunity gives a proper signal. So we have to initiate that. So this is how you should form a pair and trade in the future. So now how you can utilize this particular concept for your investment. So for that you need the help of the volatility. So here if I compare the, so this is HDFC, so HDFC Bank, and in fact HDFC Bank having a higher volatility as compared to the SBI. So I'm just taking the HDFC as independent, and I'm just taking the State Bank of India as dependent, because I have already pre-calculated SBI having the lower volatility as compared to HDFC. So HDFC Bank and SBI I have taken, and here the decoupling factor is very negligible, 0.94. It has not come to that +1 to +2 level. So +1 to +2 level it has not come. So here I cannot say that yes, SBI is cheaper I can purchase. However, let me move to other pair. So if I am just going for the ICICI Bank, ICICI Bank also having a lower volatility as compared to HDFC Bank. So here, this is giving me positive 2.77. So if I am at a situation where I have to invest something in the banking stocks, that too in the frontline banking stock, if I wish to invest something on the frontline banking stock, and I have three choices here. Suppose if I have SBI, HDFC Bank and ICICI Bank. So these three choices, so definitely you will say that out of these three, whichever is best, I should invest. So how that best factor you will derive? Out of these three things, which is available at a cheaper cost as compared to the other two, need to be chosen for my investment. So how to find it out? First we have found out which one is the higher volatility stock among these. So this is the highest volatility stock. This is the second highest and this is the third highest. So first what I did, the highest volatility stock HDFC Bank I have taken. Compare with SBI, I found out no opportunity is there. It is just net decoupling is 0.94. Then I dropped that. Then I just compare HDFC and ICICI. So while comparing this HDFC and ICICI, I found out that this is 2.77. This is coming as a positive factor. So once it is coming to as a positive factor, then definitely HDFC must be invested. So independent must be bought. Independent must be bought. So positive, independent stock must be bought here. So here, out of these two things, if I am going to choose my investment for the next 3 months, then I must choose the HDFC Bank. For the next 3 months, the HDFC Bank is going to give me the better result as compared to ICICI Bank. So this is how you can also use this particular concept for choosing the best stock from a basket of stocks. You can take some 3 to 5 stocks, but if your numbers are too many, if you are taking some 500 stocks, 200 stocks, from there to find it out, it is quite difficult. So do not go for that. If you have, first you select 4 to 5 stocks from the same sector, then just find out, arrange those stocks based on their volatility. Try to simulate based on this higher volatility stock with all lower volatility stocks. So you will find out the stock which is available at a competitive price. And since you have taken the 3 months data here for your investigation, so this investment is for 3 months. So for the next 3 months, if someone says, which stock I should invest among these three, I'll be advising the HDFC Bank because the other pair having a negligible decoupling, but still that one also positive. Here too it is positive. So I'll be advising to go for this stock of HDFC Bank because it is having a good decoupling factor. So when the distribution of the asset class happens, when the distribution of portfolio happens, so this stock will be impacted less as compared to the others. So that's why this stock is being chosen. If you are using our Smart IT software, we have also given the pair trade feature using the same concept. So just you need to click here and rest of the things it can take. I am just taking index future. I am taking Bank Nifty. I am taking State Bank of India, Savoy. I am just taking HDFC Bank. If you are having our software, you can just load the data and it has two analysis tab here, intraday and positional. So you can utilize this particular report for intraday or for positional. So all this parameter you have got, beta decoupling you have got, you have first pair, second pair, third pair. What are the pair is having, that also you got it. So here you are getting the technicals like beta decoupling. If you are going for intraday or positional, you'll be getting beta decoupling alpha, Jensen's alpha, Sharpe ratio. And here you are getting the outcome. Beta decoupling recommended, trade is not recommended. So here this combination also intraday trade is not recommended, and here too also intraday trade is not recommended. Whenever the intraday trade is recommended, so it will show you this parameter of beta decoupling recommends the trade. When that opportunity comes, it will give. And when you are going for the positional trade analysis, so for first pair, what it is showing here. So so here uh, so here out of this 5 analysis, Bank Nifty is having only one favorable analysis for buying and 4 analysis for selling. State Bank of India having 4 in the favor of buying and 1 is favor of the selling. So this is saying buy SBI in the range of this one and hedge it with a put option, strike equal to or less than this, and sell Bank Nifty in this particular and hedge it with a call option of this strike. So this kind of analysis you can get for the first thing. And when to exit that, so this is also, it is giving you here the exit option. Second pair, Bank Nifty and HDFC Bank. So how many favorable for buying, how many for selling, and what it recommends, which range you should enter and which range you should come out. So this also gives, so if you are going for a positional pair trade analysis, so this gives you whenever it is recommending you to hedge it with some option, you can hedge. When the correlation is favorable, it won't suggest you to hedge it with any option. And this is these positions we have given a clear cut indication, minimum 3 days to maximum 10 days you can hold on to this particular position. So if the intraday opportunity is there, you can very well enter in that. If the opportunity is not there, positional opportunity is there, you can enter. So out of these 3 things, you can choose any one. So this is telling with the hedging. So this pair telling that you can, without option hedging, you can enter the trade. And this is also saying that so trade is not recommended here. So this pair is not having good opportunity, and trade recommended without option hedging and trade recommended with option hedging. So if you just compare between this, so this is more simpler to me, Bank Nifty and HDFC Bank. Trade is recommended without any hedging, you can enter. So trade is well recommended here. So without any option hedging also I can enter here. So simple, buying a Bank Nifty and selling a HDFC Bank. And once that decoupling phenomenon goes, then I will be at a profit. So 3 to 10 days period I can hold. So this is how you can form the pair trade position using our pair trade software, which is very much available in our Smart IT tool. And this uses the same concept. Here only one concept out of that I have given, beta decoupling concept. But once it is adding some other analysis like your correlation analysis, another group of ratio analysis, Jensen's alpha, Sharpe ratio and Turner ratio. So it is the result gets refined and you used to get more accuracy on that. So if you do not have the software, you can still use this particular concept with the help of a Excel sheet. Just take the past 10 days data, calculate the beta. As per the beta, what is the expected price move? How much the decoupling? Once the decoupling moves above +2 level, buy the independent and sell the dependent. Once the decoupling moves to -2 level, buy the dependent and sell the independent. So this is the simplest process of your pair trade technique named beta decoupling technique. So, and I have also explained to you how one trade, the past reference I have taken, When that decoupling has gone to -2 level, the trade is being initiated, and from there when that decoupling has just shrink to near 0 level, so how much profitability it has given. So similar way, if you can just club the data and see it, you can get that clarity on this method how it works. And this phenomena is a continuous phenomenon, and it is continuously happens in the market. And this happens in the market due to the accumulation distribution pattern of the market. So nothing secret about that. Whenever that distribution phase happens, you get decoupling. When that accumulation phase happens, that you used to get the recoupling. So you enter at a decoupling stage and come out in a recoupling stage. So this is the technique of this pair trade. Telling you before I've started this event. While identifying any chart pattern, what are the common mistakes we used to do? First, we used to ignore how many candles we need to identify a pattern. Just it look like a head and shoulder pattern. I am saying it is head and shoulder pattern. So chart pattern is a perfect mathematical manifestation of price and time. However, many ignore that scientific nature of that pattern. They put whatever has come in their mind, they have put it, and without any proper validation, they have given some outcome. And here you need how many data points are required, how many candles are required to identify a pattern. That is very important. And which are the patterns which will not work in intraday chart, and which are the patterns will work in the intraday chart. And every pattern is having some hidden geometry. It is just a geometrical formation of the price time chart, and it is quite difficult to decode also. And this also speaks something about your demand supply scenario at that particular time. So this is also mathematically you need to validate it. And it is not invented by anyone. So this is also another very big truth about the pattern. The chart patterns not invented by anyone. None of the researchers so far has claimed that yes, this cup and handle pattern, head and shoulder pattern is invented by me. So it is through the trader's experience it has come, and many documentations you will find out. Through that particular documentation process, we have just recorded few facts about that. Few facts about that. It is just a trader's experience. This visualization technique is just a trader's experience. So I'll just talk about trend continuation pattern. Means if such kind of pattern happens, then the trend, whichever the trend is there, it will continue. So here, if you just say it is some price and time action happened, and if I join all the highs of that particular period, join all the lows of that particular period, I am just getting two parallel lines just tilting towards right hand side. So this is known as your flag pattern. Similar way you can get the head and shoulder pattern, cup and handle pattern, inverted head and shoulder pattern, double top, double bottom, many patterns you get. So once we form a flag pattern in this order, so it has started from a high and it has a last high, and since these lines are the parallel, so in between that also some price points are there, where this is the price graph and this is the timeline. So some pricing point is there, this is known as the height of the channel. So after getting all these technical parameters, how we can decode this pattern? How we can say that definitely we will say that when this pattern will give a breakout, and if it is given a breakout, then how much success it can give. So here this has 2 points. Most of the nominant authors in this particular pattern arithmetic, when I culminate all the data points, I found out that most are agreeing with this particular fact, adding the height of the channel, so which is nothing but this one, the height of the channel, adding the height of the channel to the last height, that will be the flag breakout point. So here is the last height. If I add how much price point is between this, then that would be a pattern breakout. Means this will be a bullish pattern. This pattern is a bullish pattern. So when this last high, so if last high is 500 and this height of the channel is 25, so above 525, the pattern will be a successful. I can say that yes, flag pattern, it became a successful. And if it becomes successful, then the targets, what the final target the flag pattern will give me, high plus that height of the channel. So the highest high whatever is recorded in this particular channel formation time was 25 points. So this 25 point, I am just assuming it is the height of the channel. So this is how the flag pattern is decoded. However, certain rules are there. When you are utilizing this flag pattern for intraday trade, minimum 8 candles, means 8 data points you require to validate this pattern. If you are taking daily, weekly or monthly chart, then 8 days, 8 weeks or 8 months is required for forming this thing. And you are just joining two lines. All the highs and lows you are joining, and it is giving you a parallel type of parallel lines. So while joining this trend line, this trend line must touch the 4 different price points. Out of these 8 price points, 50% of the price point must lie on this trend lines. Then only you can say it is a flag pattern. Out of 8 points, if only 1 or 2 points lying in this particular trend line and the remaining stays out, then I cannot say it is a flag pattern. It may be a, you can say pennant, it may be a triangle, it may be a different pattern, but it may not be a flag pattern. So at this trend lines, whenever you are drawing, it must be parallel. It must be parallel, means no point of time if you just extend this trend line, there is no scope that these two trend lines will touch at any point of time. So this is the 4 different rules of a flag pattern. So these are the things we have given in our technical studies. If you possess our technical analysis course, you will be learning the patterns in this way. What is the rules associated with that pattern? When that pattern gives a breakout, when that pattern gives a failure. So these are the things you will learn in our courses. So as I told you, our technical studies are entirely different from the others. Whatever the technical studies we have put in our technical analysis course, or in the investment course, investor course, or in the electoral course, everything is validated with mathematically. And once you try those concepts in the real market, once you try those rules in the real market, you get success in that. You get the success in that. So that price point happens in the chart. So many will tell you that whenever the flag pattern means just draw 2 lines, then just see it is looking like that or not. How many data points I require in between that? How I can find out a breakout of this pattern? Breakout means this pattern will break. Then only you can get the next targets. So if that breakout happens, then where it will lead you? What is the final target you can achieve? If this pattern fails, then where it will land you? All these things having a perfect mathematics behind it. So those are the things we can learn in our courses. So this is one of the pattern I have told, and many videos you can find it in our website. Many other patterns like head and shoulder pattern, like many candle patterns, all these things I have already taken in many videos. So in our YouTube channel, you will find out lot of literature associated with the candle patterns, linear patterns, and continuation pattern and other stuffs. So many things you can get in there. So coming to our courses and details, like I have explained. Here, beta decoupling concept comes in the F&O course. Technical concepts comes in the technical analysis course. So I have also explained the uniqueness of our courses. And we have 12 different products. If you just wish to own all those products, it costs you 17,500. And if you want those products along with one year's extensive support, which is spread over 12 months, every month you will get certain stuff to learn through webinar platform. So if you go with that, it costs you 22,500. Individually, if you buy all these courses, it costs about 47,000. So if you take all things together, it costs you 17,500. So any query related to the product, you can call in these numbers, which is flashing on your screen. So these are the sales numbers you can call. Any query associated with our discussed concept, whatever the concept I have discussed, any query associated with that, you can post your query here also. So that any query associated with the concept, you can post it in our website in the query tab. Any query associated with the product, you can feel free to call us.